The client was about to list a $1.2 million rental property for sale, and he wanted to know how much tax he was going to owe once he sold it and what are his opportunities for paying less in taxes. All right, I said, well, the first thing we're going to need to do is look at your depreciation and amortization schedule because that is the starting point for figuring out how much capital gains tax you're going to owe when you sell a rental property. Now, the depreciation and amortization report isn't something your accountant necessarily gives you every year. It's not part of your official tax forms, so you might have to request it from your accountant. You might have to go into your tax software and print out the version of your tax return that specifically includes this. Nevertheless, he got me the report. Turns out he had purchased this rental property for $300,000 several years ago and had already taken $100,000 of depreciation, which means that his cost basis, which is key for determining how much gain we're going to pay, his cost basis, right? 300K purchase price minus $100,000 of depreciation means his adjusted cost basis was $200,000. He was going to sell it for $1.2 million. This means we're going to have $1 million of gain. So, with that $1 million of gain, there's two different tax rates being applied against it. One is for the depreciation recapture. Remember, we've taken $100,000 of depreciation. So, typically, the amount of tax we have to pay on that depreciation recapture is 25% or your tax bracket, whichever one is lower. You're in the 37% tax bracket, you're only paying 25% on that. You're in the 12% tax bracket, then you're going to pay 12% on that recapture. So in this case, client was going to be in the 24% tax bracket. And so he was going to end up paying 24% depreciation recapture. Now we got to look at the other $900,000 of gain. And on that, he's going to be pay capital gains. He was going to be in the highest capital gains bracket, right? There's 0, 15, and 20%. So when you're in that highest capital gains bracket, you're typically getting hit with net investment income tax, which is another 3.8%. So we've got 23.8% there. Let's go ahead and round that up to 24%. And even though, sorry, no, even though 24% is what he's going to pay in taxes if he sells that rental property for $1.2 million because he's got $1 million of gain times 24%. That's $240,000 of taxes. And that is not including any state taxes due. So I said, well, wouldn't it be nice if you didn't pay $240,000 in taxes? He says, it sure would. I said, well, what are your goals with this money? He said, well, I'm kind of thinking about buying a different rental property. I don't know, maybe I'd move into it one day. I said, great. Do you understand what a 1031 can do for you? With a 1031, you can take all of this $1.2 million you're going to get, use it to purchase a new property, and then you don't have to pay $240,000 in taxes. You don't have to pay any money in taxes because you used a 1031 to sell one rental property and buy a new rental property. Now, if you're considering moving into it, I definitely recommend waiting 2 years before you move into that rental property. Could you move into it maybe in a year? Maybe, but I'd probably do 2 years because then you're covered by Safe Harbor, which I believe is 2008-16, the Safe Harbor for essentially moving into your 1031. So he really liked that idea. And he said, well, what else do I need to know about the 1031? Well, you gotta engage a qualified intermediary before you sell. The qualified intermediary is essentially going to act as an escrow company, right? They're going to take the 1.2 million and then they're going to distribute it to the seller of the home that you eventually buy, right? And we've got time frames we have to be concerned with. You need to purchase that new home within 6 months, and you need to have identified 2 or 3 new properties within 45 days. You don't have to buy all 3 of the properties, but you can identify 3 properties. Hey, qualified intermediary, I'm going to buy one of these. Okay, great. So those are some important factors to consider when doing a 1031. Additionally, the new property needs to have essentially the same value or more than the property that you're selling. And if you had a mortgage on the property that you're selling, the new property should have the same amount of mortgage or more. I'm talking very generally about 1031s. There's other little nuanced details to come into play. But in this case, I helped this client figure out, hey, here's how much capital gains tax I'll owe if I sell my property and do nothing. Here's how much I'll owe, which is zero, if I do a 1031. Some other potential options here would be a qualified opportunity zone. Not going to bore you with those details. The payout and the wait time is kind of long on that one. And also some stock loss harvesting. So if you've got some stocks that are losers, they've been sitting there selling those in the year, you have this big capital gain amount, could help offset the amount of capital gains you play. Now, had this client come to me after the sale of the house, we would not have had the 1031 option. So, what does this tell us? You got to create a tax plan. Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.